All commercial organisations face a number of challenges in budgeting and cash flow forecasting and management reporting. These include the ability to predict profitability from one period to the next, the ability to match revenues with the cost of products sold, performing what-ifs on volumes, pricing and new product lines, managing inventory levels and seasonal purchases, quantifying working capital and funding requirements, and of course reporting actual to budget results by product, location and from a consolidated corporate view. So let's now look at an example, one of a software company that provides software sales, support, training and consulting services, to see how a driver-based forecasting system helps solve their planning and reporting challenges with great speed and accuracy and without the complexity of spreadsheets. Although this example is for a software provider, the techniques could be applied to a wide range of businesses. A key feature of this model is the list of activity drivers in the non-financial area. They include price and volume drivers for each of the key operational activities, such as training courses, software sales, consulting and support services. Here we can see the driver list for training courses, including the number of participants, cost of catering, materials, revenues, travel and venue hire costs. For another business, drivers could easily be a product list with differing price points. In this case, the drivers are linked to Excel to help speed up the budgeting and rolling forecasting process by focusing management's attention on the things that they do rather than just plotting revenue and expense figures, as well as enabling price and volume what-ifs. Two other advantages of incorporating drivers include the ability to report back actual to budget and forecast activity trends, and to provide an easy method for extending the forecast well beyond the year end in order to eliminate the need for the annual budget round. If we now look at revenues, we can see that they are calculated by multiplying out the respective drivers. In this case, software revenues is simply based on the number of software sales multiplied by the average sales price. Training revenues is based on the number of participants times a course fee. Under cost of revenues, the cost of software sold is calculated using an equation that multiplies the number of software sales by the sales price and the cost of sales percentage. The result of sales revenues less the cost of software sold is the expected margin. Cost of training courses is a little more complex. This equation multiplies the number of participants by the cost of materials plus catering, and then adds the venue, hire and expected travel costs. In each case, as with revenues, the result is multiplied by 100%. This provides further opportunities for high-level what-ifs. To the right of the percentage are the cash flow profiles. These are the rules that determine how the balance sheet and cash flows are calculated. In this example, the default profile is set to accrue the expense to accounts payable and pay it 100% the period following. Software development costs are the direct costs incurred by the development team and are recovered via a transfer line to a balance sheet inventory account called Work in Progress Software Development. In this example, we're assuming that 100% of the development costs are recoverable, although this may not always be the case. To the right, we can see the non-cash profile that transfers the costs incurred each period to the Work in Progress accumulation account. Overhead expenses are typical of any organisation. Here we can see items due for payment the month following, whereas FBT is accrued and paid quarterly, and insurance is an annual prepayment. In the inventory area, software development costs are being accumulated. As new versions are released, accumulated costs are transferred to a finished goods version account. When a new version or updates are sold, the finished good account is amortized via cost of software sold. This accumulation and transfer process enables the correct matching of development costs with revenues to produce a margin. The finished goods account will turn negative, reflecting a profit on all the development costs. However, if development costs are expected to exceed potential revenues, the transfer percentage can be reduced, or the excess accumulation can be written off back to the profit and loss. This principle can be applied to any product manufacturer, and we can also see it used in our winery example. Looking at Results View, we can see all the available account lines, whether they are used or not. Here we can see the consolidated profit and loss, but we can choose to view each profit centre result separately. By clicking the Balance Sheet tab, we can see the results calculated for us based on the cash flow profile assumptions. Double-clicking the bank figure reveals the bank statements for the next 12 periods. Cash flows can also be viewed by profit centre and by bank account. Looking at Reports Budget, the profit and loss shows us the consolidated view. Here are the developer costs having a nil profit impact, and the results can also be printed by profit centre or any combination of profit centres. On the balance sheet, we see the accumulated bank balances, inventory, and loan management. The cash flow shows the results of all operating, investing, and financing activities. The cash flow contribution can also be viewed for each location. The driver report shows all the key operational assumptions. If printed with the equation report, users will be able to verify any variable revenue and cost result. If we now follow the monthly rollover process and import the actual results, going to Reports Actuals enables us to not only produce actual to budget and forecast results with a few click buttons, but we can also report the actual trend in the activity drivers. Here we can see actuals for the first two periods and forecast to the year end. In this report, actual to budget drivers, variances, explain why the results are going up and down. If we now view the forecast profit and loss, we can see the forecast being generated into the next financial year. If this is reviewed regularly, the driver-based forecast will eventually become next year's budget, saving a lot of time and effort by effectively eliminating the need for the annual budget process. If you would like to know more about implementing driver-based forecasting in your organization, order a trial copy now. Thanks for watching. Bye for now.